Welcome to Monetary Policy on NyQuil Part 2. So last time we talked about what money was, what made up money, and we looked at funny pictures of Nicolas Cage in sunglasses holding an AK-47. Pretty cool stuff. Excuse that burp. Now we're going to be talking about what makes up the money supply. Now money has various principal components. What we think of M naught is the money base, and it is the sum of reserves plus currency. Now note that the money base is not the same as the money supply. So the money base is not the money supply. Elements of the money base can be injected into the money supply, however. Now, what are reserves? What are total reserves? Well, like when you go to the bank and you deposit money and you get a look inside that vault back when, people actually had cash and they would deposit cash, I guess. Maybe you probably don't see all that much in the vault anymore. What you saw in that vault, those were reserves. Now, some of those reserves back in the day were required reserves, RR, and some were excess reserves, or ER. If we were to let the deposit component, so just the amount that you put in, say $1, right, be, say, capital D, then that dollar would be split up between required reserves, excess reserves, and, well, currency. So the cash that you see in the bank, that vault there, are reserves. Back in the day, some of those reserves had to be held on to by the bank in case someone wanted to withdraw funds from their account. Now, that has since changed. As of 2020, the Federal Reserve did away with the required reserve thing, and now it's just reserves. So think of it as like RR plus ER. It's just R now. Now, the thing is, right, if you had these required reserves, back when they had the required reserves, the idea would be like you'd be in a bad spot if somebody wanted to withdraw all their money and you had no money to give. Now, the Federal Reserve, for various reasons, has done away with that required reserve ratio, and instead the banks are just sort of expected to hold on to what they think is necessary, and I guess for the most part it's kind of working out. But if you ever want to know what happens if the bank doesn't have the money and everybody comes in and wants the money, watch It's a Wonderful Life. I probably should have, I guess assigned that movie at the in the fall semester because, Christmas is right around the corner or whatever. But hey, life, such is life. And It's a Wonderful Life. Watch that. There's a great scene with a bank run. And it's actually a really informative scene too. And hopefully we have some time to talk about bank runs later in the course and we can learn about that scene a little bit more. Okay, so back to the money base and splitting that deposit component up to reserves plus currency. RR would be the ratio of required reserves to deposits that banks have to hold. ER would be excess reserves that the banks choose to hold. C is the currency to deposits ratio. So once we've removed that D from the individual component in the equation, RR, ER, and C are all fractions that just add up to 1. So they're fractional pieces of how the money base is going to be composed. And then D would just be a scalar equal to the size of the money base. So if the money base is equal to, what is that, $100 million, RR is 0.15, ER is 0.1, C is 0.75, well, then that just tells me, okay, 15% of that is required reserves, 10% of that is excess reserves, 75% is currency. So they're all fractional components of the money base that, add up to 1, and that would thus explain how the money base is composed. So here's the United States money base from 1990 up to about 2022 or so. I should probably update this for 2024, but I didn't. So yeah, that's that. Now, if you're looking here, you can see okay, it's following kind of a nice little upward trend, and then around 2008 or so, you get these huge spikes, and then it kind of starts to taper, and then by 2020, you get another huge spike. These were all major borderline catastrophes in the U.S. economy. This is the financial crisis of 2007 and 2008. It took 3 rounds of unconventional monetary policy, what's known as quantitative easing, to hopefully try to stabilize, I don't know, hopefully, but to try to stabilize things and get things on track to where the Fed felt they could begin to taper some of their purchases. Kind of tapered down a little bit, and then boom, well, COVID, and that sucked. Here are the components of the money base. Well, we've got the money base, and we have currency and reserves. So what you're seeing in the green and the purple is summed up, gives you the money base. Now you can see currency, okay, has a nice little upward trajectory, nice little borderline smooth trend. Then it kind of ticked up a little bit after 2008. But the real change here was in reserves. Now, when the Federal Reserve engages in expansionary monetary policy, what they're doing is they're buying government treasury securities via the creation of reserves. So what they did is they created reserves and bought a lot of treasury securities. They bought some mortgage-backed securities as well, and basically just converted what these financial institutions were holding into cash. So they just took something that was illiquid and made it incredibly liquid, money. But we'll get into that a little bit later. So we've covered the money base. What is M1? Now, M1 makes up the measure of the money supply that has currency, which is like the physical money that you carry around, as well as checking accounts, demand deposits, and negotiable order of withdrawal accounts. Now, if you note, we divided M1 by the money base, thus taking out the money base from M1, but we're keeping 1 plus C because reserves aren't part of the money supply. Reserves are part of the non-deposit component. But currency is part of the money supply because why? You're carrying the money around and you're using it to buy stuff. So we keep currency in and we remove the reserve stuff in there. So this is a money multiplier, and it's a broad monetary aggregate expressed as a multiplier of 1 plus that currency component divided by the non-deposit component of the money base. And ER is excess reserve, at least was, determined by the Fed's policies on discount lending, and then currency would be determined by the public. How much cash do people want to be able to carry around? How much cash do they feel comfortable carrying around? Now, that's M1. We have M2, which is everything in M1 plus most savings accounts, money market accounts, retail money market mutual funds, and small denomination time deposits. If we were to look at M1 and M2, all right, M1 is in green, M2 is in the purple, we can see that M2 is a broader measure of the money supply than M1. It holds everything that M1's got plus more stuff. Well, how much more stuff? Well, at any point, say 2015, look at this vertical distance between the purple and the green. That's how much more stuff. So moving on from M2 over to M3, well, it's everything in M2 plus certificates of deposit, institutional money market mutual fund balances, deposits of Eurodollars, and repurchase agreements. Thus, it's a broader monetary aggregate. But if you're noticing, the broader the monetary aggregate is, the less liquid it becomes, meaning it's now harder to turn it into spending cash, right? Just nice green folding money. You don't really have that as you go further and further out. I mean, you have it, but it's not all just that. It's less liquid. It's harder to turn into folding money the broader the monetary aggregate gets. Now, the U.S. banking system operates under what is known as fractional reserve banking. And it's a system in which banks take deposits from the Freemasons, and I'm kidding. They take deposits from the public and are required or were required to hold a portion of their deposit liabilities in liquid assets as reserves. Now, they're not required to. They hold what they think is necessary. They're at liberty to lend that out, that portion of deposits out that they want to lend to other borrowers. And the bank reserves are held as cash in the bank, and the Federal Reserve Bank used to determine the minimum. Now, I've got it saying like determines the minimum because this is sort of the convention. This is the way everything was taught before. And so I guess it's at least good to know how things were back then to understand where we're going now. So It would determine the minimum amount that banks have to hold in liquid assets. And this is what's known as a reserve requirement. Now, banks hold less in reserves than the amount of their deposit liabilities. And because deposit liabilities are considered to be money, because they're components of M1, under fractional reserve banking, the money supply exceeds the money base. So really what's happening here is that the central bank is regulating the creation of bank credit. They impose these reserve requirements and set capital adequacy ratios to make sure the banks remain solvent and have enough funds to meet demand for withdrawals. Also to limit the process of money creation to try to prevent runaway inflation. And one of the reasons why the Federal Reserve did away with the reserve requirements is they realized that it really wasn't that effective a tool in curbing scares of runaway inflation, because there were other things like just open market operations, things like forward guidance, stuff like that, was actually playing a better role in managing inflation than setting reserve requirements. So all of this allows the central bank to influence the money supply. Now, depending on what you may have heard, maybe you think that the Federal Reserve controls it by diktat, meaning they just say, we want the money supply to be this, we want inflation to be this, we want interest rates to be this. It doesn't actually work that way, thank God. In the United States, what happens is the Federal Reserve pursues an interest rate target. And that interest rate target is the federal funds rate, which is the overnight lending rate between banks. And what happens is this controls the issuance of bank credit and thus the rate of inflation. How does this work? Well, the Fed basically has borderline monopoly power. So they'll say, we want interest rates to be a certain rate. And then what they will do is they will buy or sell government treasury securities, and also sometimes mortgage-backed securities if things are bad enough, in order to get the interest rate to the level that they want. When it reaches that level, they cease their operations, or at least slow them down a little bit. And because that is thus controlling the amount of reserves that are being held onto by banks, and then these reserves can be lent out by banks, thus creating money, they are controlling the rate of inflation. So the idea is if you have influence over how much money can be created, then you can have an influence over the inflation rate. Now, there's pros and cons to this. The pro is you have financial stability. The monetary authority can use the money supply. They can influence the money supply and thus interest rates and inflation to promote macroeconomic stability. It makes it easier for banks to provide credit. And it can also make it easier to provide longer-term loans to borrowers because, again, there's more financial stability. You trust things will be okay in 10, 20, 30 years, so you don't mind lending the money out now. But, if there isn't financial stability, you're probably there's not going to be much of a market for long-term loans because you don't know if things are going to be good in 5 years, let alone 10 or 20 years. There are some cons to this as well, though. It's, no system is perfect. If banks can't maintain enough reserves, well, they may not be able to cover all demands for their withdrawals. You could have a bank run. A lot of modern banking systems have frameworks to try to prevent bank runs, but that doesn't mean they never happen. If you look at Silicon Valley Bank in 2023, well, there you go. So bank runs do still occur. You could technically argue there was a bank run in 2008. It just wasn't with the depositors. It was like with other financial institutions. It was a really strange thing. So there is always this concern for a run on the bank. So how does money get created? Because I've talked about it a lot, but it's always kind of like passively, money gets created by X, Y, and Z, and that's that. How does this actually work? Well, let's say I buy a new car, and it costs $50,000. The Fed's got a 10% required reserve ratio. I'm going to give that car dealership the $50,000. They're going to deposit that into their own bank. Now, their bank can lend out, let's say, 90% of that, or $45,000. And they have to keep $5,000 as required reserves to make sure there isn't a big run on the bank. $45,000 just got created. Now, why is that? Well, it's because in fractional reserve banking, that deposit is a form of money. You think of it in terms of like assets and liabilities, right? That money was given to them. It's deposited, right? That makes it a liability. But they can lend that money out and then make it an asset. And because it's being lent out, when it gets repaid plus interest, that bank actually gets to make money. It's actually how banks make money. Isn't just by holding your money. It's actually you giving them, letting them borrow your money. They do stuff with your money, earn interest on it, and then that interest they earn is really like the bank's profit. So whoever that bank lent the money to is going to end up depositing it somewhere else when they buy a bunch of stuff. So let's say they get, some other bank gets a $45,000 deposit. They can lend out $40,500, keeping out $4,500 for themselves. Well, now $40,500 was just created. Then it gets deposited somewhere. And that bank can then lend out $36,450, thus creating $36,450. And it goes on and on and on and on and on forever. It actually gives us an infinite sum. Whereas delta MS, or the change in the money supply, is equal to MM, which is the money multiplier, times the change in deposits. Now, if we let lowercase r be the amount that we can lend out, and D be the initial deposit in the bank, it looks something like this, where the change in the money supply is an infinite sum as I goes from 0 to infinity of r to the power of I times that initial deposit. This is actually a geometric series, right, where r, the sum as I goes from 0 to infinity of r to the power of I, given that r is less than 1, converges to 1 over 1 minus r, geometric series. So if we were to expand that out, we would get r to the 0 plus r to the 1 plus r to the 2 plus r to the 3 plus r to the 4, blah, 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 given, of course, r is somewhere in the 0, 1 interval. If r is in the 0, 1 interval, then this series converges to a finite number. And, well, because the reserve ratio is less than 1, it is guaranteed to converge to a finite number, which gives us 1 over 1 minus r, where r is the excess reserves. But since 1 minus excess reserves equals required reserves, we could just make it 1 over required reserves. Thus, from that initial $50,000 deposit, we end up creating an additional $500,000. Now, if we were to increase the reserve requirement, say to 20%, we wouldn't have created $500,000. It would actually be a lot less than that. So let's do an example to see how that works. So the deposit's still $50,000, but now the requirement is 20%. Well, the bank, after getting that initial $50,000 deposit, can now only lend out $40,000. So $40,000 just got created. And after that $40,000 is deposited, the bank can lend out $32,000. And this goes on and on and on like before, giving us $250,000 rather than $500,000. So under the old system, if the Federal Reserve wanted to reduce the amount of money creation, they would raise the reserve requirement. Thus, less money could be lent out. If less money is being lent out, you have fewer dollars chasing just as many goods, and you are reducing the growth of money, thus reducing the growth in inflation. So as we can see, back when the Federal Reserve could change the reserve requirement, they had an impact on the amount of money that got created. If the reserve requirement went up, well, less money. If the reserve requirement went down, it meant more money. And there are other ways that the Federal Reserve, I guess I should just now say ways that the Federal Reserve can change the money supply because they don't set reserve requirements anymore. Reserve requirement is effectively 0. So like altering the reserve requirement, well, I guess they can't now. They can, and even could back then, alter the federal funds rate via what's known as open market operations. This is one of the many tools the Fed has in controlling the money supply. So I guess I should explain that a little bit more, since I briefly touched on it, and it's not entirely in this lecture. What happens is the government will sell these treasuries, right? When they need to borrow money, they sell treasuries, which is basically just, it's a bond, it's an IOU. Once that treasury hits the market, right? So the treasury has sold these treasury bonds or these treasury bills or these treasury notes onto the market. The Federal Reserve will then come in and buy those treasuries back up. So they will buy those treasuries, and by buying those treasuries, they are directly controlling the amount of reserves that banks are holding. based on the amount of reserves banks are holding, think of a kind of supply and demand thing, right? If the supply of the reserves goes up, then the price of borrowing those reserves goes down. Thus, the interest rate goes down. And thus, they will make an announcement for the price of money, the interest rate, but what they're really doing is affecting the quantity of reserves that are hitting these banks. And then the banks will either lend the money or they won't lend the money. And that's really kind of, a brief intro, I guess, into how the Federal Reserve uses open market operations to affect the money supply, interest rates, inflation, and hopefully by affecting all of those in favorable ways, output and unemployment. But I guess that's really enough of that for now. Next time, we're going to talk about the demand for money in the U.S. So thanks for watching this one. And peace out, I guess, or whatever. So thanks for watching. Bye.